My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer America. I'll be my friends. I'm just trying to make you a little extra money here. My job, not just to entertain, but to educate and teach. Call me 1-800-743-CNBC. Tweet me at Jim Cramer. When people think about an exciting time for stocks, they think of the next 2 weeks. That's when some of the most important consequential companies on earth report, practically at the same time. Throw in the actions of the new president, and all I can say is we are not going to have any idea what the heck we're doing until we have time, probably at night, to sift through all the data points and study all the conference calls. Yes, 8 times a year, 2 weeks a quarter. You have so much information to deal with that it's impossible to not make mistakes. Unless you take my advice and do nothing but listen. It's the only way you won't hurt yourself. Compared to the next 2 weeks, today was easy. Dow dipping 141 points, S&P declining 0.29%, NASDAQ losing 0.5%. And NASDAQ, did I mention the videos down? Okay, there, I said it. All right, now, what is exactly the game plan? Well, what I've done is truncate it and just focused on some of the bigger ones, but there's so many others that I could have focused on. We don't have all day here. Next week starts out calm enough when we hear from fan favorite SoFi on Monday morning. Now, I've been championing this fintech company and CEO Anthony Noto for ages, but it was one of the most heavily shorted stocks out there, and they've been keeping it down for no reason. I expect good numbers, and the shorts are going to continue to be routed. AT&T reports, too, and given that Verizon, it didn't stink up the joint, I have to think AT&T will be fine. Tuesday morning, we hear from General Motors, which delivers usual great numbers, and after a nice opening, it will drift down and remain one of the cheapest stocks in the S&P because in the end, it sells cars. And the market only has eyes for one automaker, Tesla, and that's got nothing to do with the car business. After the close, we hear Brian Niccol lay out his vision for Starbucks. Now, we own the stock for the Travel Trust, and I think it might be worth buying after we hear the new plan. I believe in Brian. He did an incredible job turning around Chipotle, and I bet he can do the same thing with Starbucks. Remember, when I said this week's too difficult for snap judgments, the Federal Reserve doesn't make it any easier on Wednesday when it tells us its next move. There was a time when we thought that we'd be getting a nice rate cut right about now and the stock market would plow forward. But when American Express says today that its millions of customers are spending like mad, the Fed can't possibly give us a rate cut, can it? Now, if they do cut on Wednesday, it means Jay Powell has caved to President Trump's demand for immediate rate cuts. Too crazy for this guy, people. Good day to sit on your hands because it's a no-win situation for Powell, and I don't want to get caught in a Trump-Powell dogfight. At least Wednesday starts with the predictable, which is T-Mobile's earnings. Lately, the stock's been beaten down. That's precisely when you got that's the best setup for the stock if you want a post-quarter rally. Now, same goes for ServiceNow. Now, ServiceNow, let's listen to this. This is the quarter where ServiceNow will report a number that sends the stock down in after-hours trading, and you have to buy it right then and there because it will rally huge at the opening the next day, Thursday. Time and time again, this happens. It goes down after the evening report. Why? It's pushed down by short sellers trying to keep it down. And then it opens up gigantically when the shorts again are routed the next day. ServiceNow doesn't even know how to miss. Set your clock to this one, at least until some company actually attempts to compete with their artificial intelligence savvy. Buy that dip. And I almost never advise buying after hours, but I'm doing it right now for ServiceNow. How about two wild cards? First is Microsoft. Now, this has become a battleground stock because its aggressive data center build-out, a so far failed AI PC, got to call him as I see him, a possible fallout with OpenAI, and the possibility that Copilot is nothing but Clippy 2. Yes, that little paperclip that almost ruined Microsoft Office in the late 90s. I keep trying to figure out how CFO Amy Hood can be positive to her on her part of the conference call, which is really, frankly, the only part of the conference call that matters, because she handles the guidance. And the guidance is the guidance. We pared this one back for the Travel Trust, and if it weren't for the fact that Microsoft has an installed base to beat the band, I have to tell you, we would have sold our entire position. The second wild card, Meta Platforms. I think the company will talk about dominance, visceral, raw dominance, both on the top and the bottom line. Look out, TikTok. You think you're so darn hot, but Mark the Hunter Zuckerberg has you in his sights. I, for one, am glad that Zuckerberg's an American. I bet he does the quarter in Oakley A's. You know the Oakley AIs? They're cool. I have the Ray-Bans. I don't have the Oakleys. Apparently, you can't get them yet. All right, then there's Tesla. Now, I think Elon Musk, get this, I think he could sell tickets to this conference call. He could command $1,000 easy. The last time Tesla reported missed numbers badly, and then it proceeded to have one of the biggest runs ever. Just soared. Right when I reported that number, and I've got to tell you, I figured it out. Actually, Morgan Stanley's Adam Jonas figured it out for me. He calls Tesla after that quarter an AI ETF. People want an AI ETF, so they buy the stock no matter what, especially if it's down the next day. I want you to own Tesla. Just own it. Thursday morning starts with Caterpillar, which is a conference call stock, meaning you can't make a decision until you hear the call, because that's where you learn about the future. I think the stock's had an amazing run, but Cat's no longer cyclical. It's a secular grower because CEO Jim Umpleby has maneuvered his business into more consistent end markets. I said this yesterday at the beginning of the CNBC Investing Club conference call. After the close, we have the most widely anticipated disappointment that I've ever seen. I'm about to be facetious. I want you to hear this. It's facetious. But here's what we're going to hear. Let's see. We have horrendous Chinese cell phone orders, no lift from new AI, a surprising slowdown in service revenues, lackluster Vision Pro sales, and, of course, a radical chop to the forecast for the rest of the year. All way below the consensus. There. That's everything I've heard about Apple for the last 2 weeks. I just hear, and since the year began, I just keep hearing that over and over again. But if everyone knows it's going to be worse than expected, can it still be worse than expected? How can it be a surprise? If everyone expects the worst and we get the worst, will the stock still get clocked? Kinda, yeah. Because Apple's priced for slightly better than expected set of numbers and we won't get one. But so then why not dump it? No. I still say own it. Don't trade it. Because I believe Apple's an amazing company with amazing management. Whatever goes wrong will be fixed. I just don't know when it will be fixed. Historically, you're better off sitting tight than trying to trade this one. My Travel Trust has such unbelievable performance in the stock precisely because Apple controls its own destiny. Not that hard to do when management's fantastic and the product's superb. Oh, Intel reports too. Let's hope they have a way to raise cash. Different story than from Apple. They need it. Their balance sheet's heinous. You can't own the stock until they fix it. Finally, Friday brings numbers from oil giants Chevron and Exxon. I don't want to own the oils here because who knows if they cave to President Trump and start drilling like mad. I think they're going to stay disciplined. But if Trump wants more drilling, do you think he'll pick one of the little guys? No way. He'll go straight to Exxon and Chevron. Oh, and if it weren't enough for this week, we got the Fed's favorite inflation gauge. That's the PCE deflator number. And I think it won't be cool enough. Too much spending for that to happen. The exhausting bottom line, look, it's a sheer hell week. Our heads will be spinning swivel-like, lazy Susan even, as each day you can expect a flood of earnings and a soundbite from President Trump that upsets whatever order they might be. Like I always say, don't try to make decisions during this part of earnings season. Just listen. It's too hard, and I don't want you to lose money just because this is one of 8 super exciting weeks of the year. Bob in Tennessee. Bob.
Jim, good to talk to you.
Same.
I'm one of the founding members of your club.
We love founding members of the club. All right, let's hit it.
Bristol Myers. It's up 40% over the last 6 months. The market value is $120 billion. The enterprise value is $163 billion. Do I hold it?
You bet you. No, you don't hold it. You buy more. This Cobenfy I'm telling you, this is a radical new drug. It's the first new drug for schizophrenia we've seen. It works much better than the others. No weight gain. And I think it's remarkable. 4% yield and a guy, Chris Berner, who I think is dynamite at the helm. I'm not telling you it's a schnitzel, buy, sell, whatever. I like Bristol Myers. Let's go to Alex in my home state of New Jersey. Alex.
Jim, I got to thank you for all that you do for us novice investors. But I want to ask you about Hershey. Hershey, what do you think? I mean, they have a lot of pressure with the cocoa prices going up. We know they're hedging against it. Supply chain crises. We know the energy prices you talk about all the time.
52-week low. 52-week low today, 3.6% yield. That doesn't protect you against anything because you know you can get a lot more for interest rates. The stock the numbers can't be made. Still sells at 16 times earnings. Wake me up when it sells at 14 times earnings, and then I might even consider it. If you have to own sweets, go own Mondelez. Okay, just own Mondelez. I like the Tate's cookies. They're very good there. And I did Toblerone. They had Toblerone in the office today. I didn't have any. They took it right from me. I did have ice cream. First time in the office in maybe 19 years. Let's go to Ben in Florida. Ben! Ben!
Mr. Cramer, appreciate your call from Monmouth County, Jersey to Montgomery County, Pennsylvania.
Oh, my. Springfield High School to the championship. Let's go.
There you go. Hey, can you tell me why it is that nobody has any respect for PayPal? And go Birds.
Go Eagles. I have no... Look, I tell you, this person does have respect for PayPal. They have a meeting in February that is going to blow your socks off. I have to tell you that I think that this guy, Alex Chris, is the real deal. It's at 89. Buy some now, and if it does happen to come down before February, buy more then. I have total respect for PayPal and total respect for Alex. It's a good stock and a good company. All right, leave it to Ben to know that. I want to thank Ben. Next week brings a flurry of earnings. Pair that with the Trump news cycle, which happens every day. It's the spin cycle. It's kind of like my washing machine, and you're going to have to practice patience. I know it's hard, but it's going to be a virtue. On Mad Money tonight, Intuitive Surgical, ISRG, fell on yesterday's report. So is this chance to buy a dip of one of the greatest companies, like one that I love? And what's the investing club doing to take action on this move? Because, man, are we ever tempted? Then, NVIDIA backed this little-known AI stock. But should you? I'll reveal the new name of it. And tell you whether it's worth eyeing. Plus, I'm giving you a behind-the-scenes look at the CNBC Investing Club as I take some members' questions left over from our monthly meeting yesterday. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Last night, Cramer fave Intuitive Surgical reported what I thought was a good quarter. But this minimally invasive robotic surgery play saw its stock fall 4% today in response. So I figured we got to get to the bottom of this one because I really like the stock. In fairness, Intuitive Surgical stock is up almost 55% last year, and going in today, it had run nearly 17% year to date. Even after this pullback, it's still up almost 12% in 2025. But I still hate to see declines like this. Intuitive Surgical caught fire last week because it pre-announced strong top-line numbers ahead of its presentation at the JP Morgan Healthcare Conference. That sent the stock up nearly 8% last Wednesday. And I got to tell you, I thought that ISRG was the star of the whole show. So how in the world did they disappoint investors so much last night, given that they'd already pre-announced great numbers last week? Did something big happen? Look, in yesterday's monthly meeting call for CNBC Investing Club members, I briefly mentioned Intuitive Surgical, saying that we were thinking about adding it to the portfolio. I'm glad we waited. But now I'm wondering if it's time to buy the dip. Do we have to pull the trigger? Why? Why did this happen? First, last week, they really did pre-announce some tremendous fourth-quarter results. 25% revenue growth, much higher than expected, and an acceleration from 17% growth in the previous quarter. Management said that they placed 493 of their Da Vinci surgical systems in the fourth quarter, and 174 of those were the latest generation Da Vinci 5 systems. Finally, worldwide Da Vinci procedures grew roughly 18%, which is important because they sell consumables for each procedure. I want you to think of it as kind of a razor blade business model. Intuitive Surgical followed that up with a bullish presentation at the JP Morgan Healthcare Conference, citing their growing total addressable market, a strong launch for the Da Vinci 5 system, and excellent supplemental growth from the company's Ion platform for bronchoscopy procedures. Intuitive even showed a little leg with its 2025 outlook, guiding for 13 to 16% worldwide procedures growth this year on the Da Vinci platform. These are all very good numbers. So what the heck did the company say last night to make so many investors give up on the stock today? It certainly wasn't the earnings. They made $2.21 per share this quarter. Analysts were looking for $1.79. They also ended the quarter with $8.83 billion in cash and cash equivalents. That's a nice war chest. The issue, it seems, was management's full-year forecast. Remember, the forecast, not the numbers that it just reported. Intuitive Surgical reiterated the procedure growth guidance that it issued last week. However, the company also issued gross margin and expense guidance that were new, and it seems incrementally negative. Intuitive Surgical said they expects a gross margin of 67 to 68% this year. That is down from 69.1% last year and below the 68.4% consensus estimate. Additionally, they're talking about operating expense growth of 10 to 15%, up from 10% last year. Those are important. But I got to say, any concerns about rising costs here, I feel, are overblown, if not totally misguided. If investors had bothered to listen to Intuitive Surgical's conference call, they would have heard some very reasonable explanations for the modest step back in profitability. First, management explained that the expected gross margin decline reflects, quote, significant incremental depreciation, end quote, as they bring on new facilities, as well as, quote, the impact of growth in newer products and the impact of the stronger U.S. dollar, end quote. Now, let's take some time on this. Intuitive Surgical is opening several new manufacturing facilities this year, 2 in California for the Da Vinci 5 and then Ion Systems, respectively, and then the new endoscope manufacturing facilities in Germany and Bulgaria. Once those facilities come online, these assets will begin to depreciate, and this is a cost that will be reflected on Intuitive Surgical's income statement. As these new facilities come online, they plan to move manufacturing for some mature products to other facilities, and as a result, it expects elevated inventory levels. Now, I think that comment, anytime you hear elevated inventory levels, that comment always spooks people. It's just going to. But anyone who's focusing on this minutiae, I think, is missing the point. What matters is Intuitive Surgical has such strong demand that they have to build all kinds of new manufacturing facilities all over the globe in order to keep up. Any pain from that on the cost side will be more than made up by the company's incredibly durable demand. As for the other two, I'm not worried about the, quote, impact of new products, end quote. That likely includes the company's Ion system. Maybe it's a couple percentage points less profitable than the classic Da Vinci system, which Intuitive has been refining for decades, but it's also pulling up their overall growth rate, and that's more important, I think, to a growth stock. Finally, the stronger dollar is something that all U.S.-based multinationals have been dealing with. It's on every single conference call that I listened to this week. While it's not ideal, it's totally beyond their control. Now, there's one more wrinkle here, which is that Intuitive Surgical added the following disclaimer when discussing its gross margin guidance. Quote, our actual gross profit margin will vary quarter to quarter depending largely on product, regional, and trade-in mix and pricing. The range does not include any potential impact of new tariffs on our business, which could be material, end quote. We think that last bit about the potentially material impact of tariffs, that definitely spooks some people. Intuitive Surgical makes a significant portion of their instruments in Mexico, which President Trump has been threatening with blanket tariffs as high as 25%. This is the kind of ambiguous threat that investors and analysts hate, precisely because they can't model it. But my feeling is that we'll deal with tariffs as they come. Once we have information about what's actually happening, we'll recalculate. Try and anticipate Trump's next move, I think, on trade, actually on pretty much anything, it's a fool's errand, because every word he says may be part of negotiation. How about Intuitive Surgical's higher operating expense guidance? Look, pretty much everything they mention here has to do with investing to grow the business. In my view, that's money well spent. Most companies don't have that much opportunity. The companies that you should really worry about are the ones that can't grow. Intuitive Surgical has the opposite problem. It is some of the best growth that you'll find, not just in healthcare, but everywhere, especially big cap healthcare. If you have to sacrifice a couple percentage points of margin in order to keep their growth rate solidly in the double digits, great deal. Put it all together, and I'm glad Intuitive Surgical started selling off today. In fact, I hope it keeps falling. The only problem with this stock is that it's too expensive right now. Currently selling for 62 times next year's earnings estimate is very high, like 3 times the average stock here. Granted, these guys have a long track record of crushing those estimates, but still nobody likes to pay up, right? Today's decline helps cool off the stock's valuation. Maybe they'll come on the show. When they came on the show last time, talked about Da Vinci 5, it was fabulous. Bottom line, like I've told members of the investing club, we've been waiting to start a position in Intuitive Surgical, and nothing about this quarter makes me like it less. You're simply getting a chance to buy the dip here, which is why I'm now praying for more weakness to give you an even better entry point. Mad Money's back after the break.
Coming up, an under-the-radar AI player with an NVIDIA kicker. The stock has soared, but is the move artificial? Cramer reveals the name and what's ahead for the stock. Next.
Last night, we got a call from Joseph in North Carolina, who stumped me when he asked about Nebius Group, which he described as a preferred partner to Cramer fave NVIDIA. And in fact, NVIDIA has taken a position in the company. I was pretty intrigued by this. But alas, I never even heard of it. So you know what I did? I came clean, and then I promised to circle back. Now, this one was tough. Tough because Nebius seems to have come out of nowhere just a few months ago. In mid-October, just before the stock started trading, the company announced what looks like its core product, an AI-native NVIDIA cloud platform. By November, Nebius was calling itself a, quote, preferred cloud service provider, the NVIDIA Partner Network, end quote. And then in early December, we learned that they'd raised $700 million from a private fundraising round that included NVIDIA. Now, in the process, the stock has surged from $14 when it started trading in October to $41 and change now, including a monster 7.9% gain today. Seemingly came out of nowhere. So we got to ask, what the heck is going on here? Now, first, the reason I'd never heard of Nebius is because this company changed its name in August. It used to be known as Yandex. And Yandex, I know. It's basically the Google of Russia, a stock that came public in 2011, but we never paid much attention to it because who cares about the Google of Russia? Now, the stock was suspended in February of 2022 after Russia invaded Ukraine, and it only avoided being delisted from the NASDAQ by promising to divest its Russian business. That deal finally happened last summer when Yandex sold its Russian unit, and then starting with a pot of around $2.5 billion in cash from that sale, the company announced a new name, Nebius, and a new mission, quote, to become a leading provider of infrastructure and services to AI builders globally. Ooh, I love that. Yandex founder and former CEO Arkady Volov, who resigned from his position in 2022 after the EU sanctioned him for the company's role in promoting Russian propaganda, had his personal sanctions lifted in March of last year, and he rejoined the newly branded Nebius as CEO last summer. So here's the deal with Nebius. In a nutshell, the company's planning to acquire as many high-end GPUs as it can, and then build brand new AI data centers, essentially selling a robust, modern cloud platform to customers. Think of it as like the Amazon Web Services, except instead of normal servers, they got servers powered by NVIDIA's best chips, ideal for building cutting-edge AI applications. Now, earlier this week, for example, Nebius announced the general availability of a number of leading text-to-image AI models through its Inference-as-a-Service platform. Inference-as-a-Service. There are a couple other parts to this business, but the core of Nebius is the AI infrastructure business. Even though it's still getting up to speed, it already made up 2/3 of the company's revenue in the most recent quarter, and it's pretty much all they talk about. Now, this idea of basically acquiring as much NVIDIA computing power as possible and then leasing that to customers, nothing new. One of 2025's largest IPOs could potentially be from a company called CoreWeave, which is a much larger version of the same story. Used to be a cryptocurrency miner, this CoreWeave, but they pivoted to AI infrastructure because these applications all use the same chips from NVIDIA. Lots of startups are moving in the same direction. It's easy to raise money for this right now. Back to Nebius. We have limited financial information on this company, but here's what we pieced together. In the third quarter of 2024, they had $27 million in revenue in the quarter and a run rate of roughly $121 million in annual recurring revenue, with their earnings before interest, taxes, depreciation, and amortization coming in at negative $7 million. You know, I don't like to recommend stocks that aren't making money, but bear with me here. In October, the company was also stating some lofty goals for 2025. They were talking about $500 million to $1 billion of annual recurring revenue by the end of this year, and they also expect their EBITDA to turn positive. By early December, when they did that private fundraising round, Nebius raised its forecast, talking about an annual recurring revenue run rate of $750 million to $1 billion by the end of the year. So numbers are coming up. Kind of like this. However, there's also some stuff that raises eyebrows. During that week in December, when Nebius shot up 67%, the stock was promoted a couple of times by Citron Research, a.k.a. Andrew Left. He's a well-known former short seller who was charged with fraud by the SEC last summer. While Left maintains his innocence, the SEC claims that he was basically running a pump-and-dump operation. Second, Nebius got its first analyst coverage last week when a firm I've never heard of called BWS Financial rolled out a buy rating and a $51 price target. Again, the stock closed at $41 today. They're very enthusiastic about the AI infrastructure business. Who isn't? Third, Nebius has repeatedly claimed to have a close relationship with NVIDIA. But in December, Bloomberg published an interview with CEO Arkady Volov, who says he might not necessarily be able to get early access to NVIDIA's new Blackwell chips. More importantly, he mentioned that the company wants to do another much larger capital raise sometime this year. Now, if they do a secondary offering, shareholders could take a real beatdown. Now, putting it all together, while I like that Nebius has given us some hard financial targets, this is already a nearly $10 billion company, meaning it's trading at roughly 20 times its full-year revenue forecast. That's incredibly expensive. Now, if you hit the company's targets, it might be justified, but that's really a big if. I honestly don't love the idea of recommending Nebius now after the stock's had this big run. Not when we're likely to get another fundraising round this year. I don't want to be a chump here. I didn't like the bit about that NVIDIA Blackwell chips where Nebius said they're coming, and then that CEO later said basically, we hope they're coming. I don't like that there's no real institutional support for the stock either. I'd rather have analysts from Goldman Sachs, Morgan Stanley, JP Morgan put their name and their reputation behind this one rather than Andrew Leff and BWS Financial. Whoever that is. Separately, you might want to wait to see how the CoreWeave IPO goes before sticking our necks out on the similar Nebius. But more generally, can I just say this? Given that the core business here is acquiring NVIDIA's best chips and then essentially leasing them to customers, why not just own the stock of NVIDIA? Do we really need this middleman with a checkered Russian history to invest in the idea that people want access to these chips? I get that NVIDIA has distribution partners. Many of them are great, like Dell or HP Enterprise. I like both of them. But what's the point of buying a company that talks about itself as a pure play on NVIDIA's chips? Keep in mind, Nebius and CoreWeave aren't necessarily doing anything special here. The traditional cloud infrastructure hyperscalers have the same darn hardware and much bigger budgets. Let me give you the bottom line on this one. I want to thank Joseph in North Carolina for putting Nebius on our radar screen, but I am not ready to start recommending the stock here. Now, if you want to invest in the idea that companies want NVIDIA's best chips, you know what? I got an idea. Why don't you simply buy the stock of NVIDIA? Let's go to Phil, also in North Carolina. Phil.
Jim, how are you today?
I am well, Phil, and how about you?
Jim, I'm fair to middling. You know, I call every once in a while, and that's what I say. I'm fair to middling. Not too high, not too low.
Phil, I know you. I know Phil. Phil's always fair to middling.
Always fair to middling. Anyway, I know you. I normally call on lightning round, but I wanted to spend a minute with you. I know your time is valuable, but you know what? My time is valuable too.
You bet, and that's how I feel.
Okay, so this stock, I just can't get an entry point. As much as I want to get in every day, it seems like it's going up. Today it was flat. So in order to get it, though, I'm going to sell my Verizon, and I'm going to wait until the beginning of February because I'll get my yields. I think it's like February 3rd. Now, this next stock, Train, I'm going to give you a new term. It's called a reverse schnitzel. I'm going to sell
reverse schnitzel?
A reverse
schnitzel. Oh, a schnitzel. Reverse, you mean buy a little instead of sell a little, sell a little.
No, I mean sell a little, sell a little bit. A schnitzel.
No, schnitzel means we're going to let some go. Well, no, I mean, in the business, what we say is we schnitzel it. We do a little schnitzel. You can buy it, sell it, buy it, and sell it. I'm going to tell you what to do. But what's the stock?
Right. The stock is Palantir, and I know
Palantir's going higher. All right, Palantir's going higher. That's the way it is. I think that it's a meme stock. I think it goes to 100. They push it up every day. I think when you get a down day, you just buy it. That's what they're going to do. And I got to tell you, Phil, it is really an unbelievable thing. This is GameStop, except for it has actual revenues and earnings. Let's go to Bruce in Pennsylvania. Bruce.
Hey, Jim. First off, long time, first time. Sincerely appreciate all that you do, and go Birds.
Oh, man, go Eagles. Go Eagles. I mean, honestly. I don't even think they should have to play. They have to play. It's unfortunate, but they have to play first.
Well, they do.
I'm not looking through the Commanders. I'm not looking through the Commanders. I think the Commanders are an amazing team. I think Josh Harris is an amazing owner. I have actual friends who like the team.
Well, I understand. And they've got a game to play on Sunday. Hey,
right, they get paid too. They get paid too. All right? Yeah.
That's right. So my stock that I'm curious about is Twilio, and I have been in and out of Twilio literally since they went public, generally done pretty well.
Right.
However, I took a position, several months ago, and my question is, I think I want to sit on it and hold it forever, given their business model.
Yes, I want you to. When I went over the quarter and then I searched through the website, I cannot believe how this company has really become one of the great assistants to small businesses trying to build their business. It's a great customer relation management tool. I agree with you. I would own it, and if it came down, I would buy more. That's a strong endorsement, but that quarter was really incredibly good. All right, I'm not sure Nebius is the best way to play a chip demand thesis right now. If you want to invest in the idea that people like NVIDIA NVIDIA ships. May I suggest that you buy the stock of NVIDIA, which is being knocked down apparently by a story out of China that may or may not be really important that was in the New York Times. Now, much more Mad Money ahead, including my answers to some fantastic questions from our Investing Club members. And later, Texas Instruments ended the day as the worst performed in the S&P 500. I'm looking at the road ahead for the chip company. All your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. Yesterday, we held our CNBC Investing Club monthly meeting. Now, once a month, Jeff Marks and I get together to walk club members through our thought process of how we make decisions for the portfolio. We discuss our current holdings, and then we take questions from our club members. My favorite part of the whole darn thing is taking your questions. And since we didn't have enough time earlier to go through all of them, I am going to give you an inside look at what we do for the club right here, right now. Remember, if you want to get in ahead of next month's meeting, well, you got to make sure you join the club first. So I want you to scan this QR code next to me. I know how to do scanning, so I know you do too. Or you can go to cnbc.com/investing club. First up is Ron in Georgia, and he asks, I thought Jefferies had a good print on their last quarter, but they got clobbered. I am holding on to the stock, and it's come back a lot since then. What's your opinion? Now, let me just tell you, first of all, because my mind is on football, I thought he was talking about Justin. I thought he was about Jefferson. No. But let me just tell you this. I think that Jefferies had a surprisingly bad quarter. I think Goldman Sachs had a surprisingly good quarter. So here's what we do. Even as I just think the world of the CEO of Jefferies, I want you to sell Jefferies, and I want you to buy Goldman. Goldman's cheaper. Goldman's better. Rich Handler won't mind that I said that, and David Solomon will be thrilled. Now let's go to Steve, who's in my home state of New Jersey, who asks, many times you talk about ringing the register. Can you give me a sense of a percent gain to start? And do you do this more than once? Many thanks to you, Jeff, and Ben, Jeff's our chief scientist, for all you do for us home gamers, and our research director. Okay, so this is really important because it's not science, it's more of an art. When a stock, let's take NVIDIA. Okay, so NVIDIA became about 7% of the fund. So we had to trim it back because it's just way too big. We became the NVIDIA fund. So we cut it back to say around a little bit north of 5%. Then there'll be other situations that go up so fast. And here I'm thinking about something like Best Buy, where it went up so fast that it didn't reflect the current fundamentals. So we trimmed some. And then there are just situations where we have such big gains that I feel like bulls make money, bears make money, and pigs get slaughtered. And we take some off there. But we never take off more than around 25% if we like the situation. If I think the situation is played out, we just get rid of it. Now let's go to Antonio, who asks, hi, Jim and team. Given their stable dividend income and their lower interest rates, what would you think about adding REITs such as Realty Income or VICI Properties? I have been toying with the idea of owning Realty Income because they play monthly checks. I think it's a really, really good situation. VICI, I don't like the last few things that they bought. I'm not going to touch VICI. But Realty Income, I really like the idea. Next up, a question from Phil, who asks, during campaigning, Trump had mentioned rolling back credit card usury fees. What would you expect the impact on American Express, Visa, and other card companies to be? Don't worry about Visa. Visa's just a kind of a transfer system. American Express, not that much worried there. The one you'd be focused on is Capital One. Now, let me tell you a funny thing here. Capital One is actually my favorite. I put it in the bullpen, so to speak. I'm thinking about buying it because of this Discover merger, which is going to be so bullish, and because I don't think there will be usury fees. So I want to go against what the president's musing was right there and buy Capital One, COF, a really well-run credit card company. Next up, Albert asks, my family has been shopping at Target for years. The stores are attractive and busy, but I continue to be disappointed in their stock performance. Is it time to put my money to work elsewhere? You know what? I actually think that there's going to be like an activist at Target eventually because it does have a good balance sheet and it's very cheap. But here's the problem. They do food. And food is something you need scale on, and Costco and Walmart do much better food. They do delivery, and that's something you need scale on, and Walmart and Amazon do a much better job. They need more pizzazz, and that is something that Brian Cornell can control, and they haven't had it lately. You don't hear like, I got to go to Target. They need to bring the excitement back, and it doesn't have it right now. Now let's take a question from Rim, who asks, love the show and everything about your style and format. Style, I guess he likes, I don't know. And this is an idea. With the upcoming AI and robotics impact, what is the investment potential of Rockwell Automation as an investment opportunity? I'm looking to gradually invest $10,000. Okay, to be fair, I have been disappointed in how much they're really doing in robotics. They've done something. They're going to tell you they do have a lot of robotics. But I'm going to just put it out there. I know you're not going to buy this, but if you want to buy robotics, here's what you do. You buy the stock of Tesla. You can wait till they report. The stock usually goes down when they report. They report this week. Get an opportunity to buy it the next day. Take advantage of it. Now let's go to Steve, who asks, my sons think Facebook is for old fogies who don't have a life, but they are on Reddit all the time. I saw Reddit's share price go up 40% in one day not long ago, and it seemed very volatile. Is this a real company that should be considered for investing, or is it a meme stock? It is very much a real company. Steve Huffman, the CEO, does a fantastic job. You're not an old fogey. I like Meta ahead of the quarter. Reddit just went up huge this week. I think you got to wait for a pullback Reddit. I would prefer to buy it in the 150, 140 range. Thanks again to all the club members for your insightful questions. And if you want more of this, make sure to join the club ahead of next month's meeting. Mad Money is back after the break. It is time. It's time for the White Market Strategy. We take Rob Roy Chambers. I started by myself. Just been in the call stock right now. My step versus everything. Play this out. And then the lightning round is over. Are you ready, Ski Daddy? It's time for the lightning round. I'm going to start with, how about David, Pennsylvania? David.
Hello, Jim. I've been following you for many years, and I want to ask you, is Tetra Technologies coming up from the ashes?
It's a very good company. It did come up to the ashes, but as a matter of fact, it's come up so much, it's up 28% for the year, so I cannot sanction buying it, given the fact that it has an incredibly high price earnings multiple. Let's go to Ann in Indiana. Ann.
Hey, Jim, I just renewed my club membership, so thank you.
Oh, thank you. Thank you.
Of course. So, do you think we should be concerned about Abbott's new lingo? Because I was reading about these smart rings. So, would Abbott still be a buy, hold, or sell? Or could
Abbott, Abbott was along with Intuitive Surgical, one of the stars of the J.P. Morgan Healthcare Conference last week. I'm glad I went out there. Regina Gogan and I went and really kicked the tires on Abbott, and we love what we saw. Robert Ford is doing a remarkable job, and the stock is up in a straight line at 125. I can't recommend anything on a straight line. If it pulls back a couple bucks, though, it's good, because this should be one of the great pharma stories, because it's got the best growth in device and pharmaceuticals. I think it's great. And the market finally seemed to realize what Robert Ford and I believe. Abbott is a great company. Big position for the trust. How about we go to Jim in Texas? Jim.
Jim Cramer, hey, thanks for taking my call. I'm here with my grandchildren in Texas.
Oh, fabulous. Lucky guy. Those kids all have horse sense, don't they?
They sure do. Hey, I appreciate the call. I'd like to thank you for three things real quick. One, your expertise. Two, how you educate people. And three, you educated my wife to the point of she's now our family financial manager, which frees me up for a lot more golf. So thanks.
Well, it is about teaching. I mean, I say it. Look, I'm done with the making. I like to make money. Everybody likes to make money. I like to teach. I would be teaching in a classroom if I weren't here. And believe me, there's no way I would retire from the classroom. No way I'm going anywhere here. Let's go to work.
Great. You do a great job. The stock is New Holding, NU.
You know, this is a fintech company, and it's a really hard company in fintech. It's very expensive. I actually would prefer, I prefer SoFi's reports on Monday morning. And thank you for those nice words. Holy cow, it makes me feel good. It's going to be a weekend. Got a tough game on Sunday. My wife would say, oh, you have a tough game? What, are you like suiting up or something? Just shut up. She wouldn't say shut up. She would just say be quiet, because she's really sweet. Let's go to Jeffrey in Massachusetts. Jeffrey.
Happy Friday, Jim. How are you, pal?
Oh, man. Yeah, I can't wait till Sunday. What's going on?
Not much, buddy. Quick question on Catella Waste. 900 P to E. Take out the trash, or what do you think?
You know, this one has been around forever, and it just caught fire. I think it's good, but you know what? I am going to go back to WM. I think WM is terrific, and it just had a dip, and it's a little bit cheaper. That's the one you should go, and we got to speak to Jim Fish. That's the one you want to be in. Let's go to Carl in California. Carl.
The now 7% yield has got me taking a serious look at Wendy's here.
I'm worried about Wendy's. That should not have a 7% yield. That, to me, says something may be wrong here. McDonald's is kicking butt. I saw an upgrade today for Burger King quality. I've got to take a quick survey, and I got to tell you, you know what? Wendy's, no. They have not demonstrated that they can pull it off in a very competitive world. And I feel bad about that because I happen to my wife loves that bacon burger. I don't know if you knew that. And that, ladies and gentlemen, is the conclusion of the Lightning Round!
The Lightning Round is sponsored by Charles Schwab.
Sometimes being the best in this business is not good enough anymore. And that's now the case with Texas Instruments, which fell 7.5% today, the worst performing S&P 500. Now, I have always loved the stock of Texas Instruments from the days when I felt they were the only semiconductor game in town. Of course, that was in the 80s. The July call options I bought while I was studying for the bar exam were my first $1,000 trade. And that's when $1,000 bought you more than a dinner for two in Manhattan. These days, though, Texas Instruments kind of feels like a relic, a company that makes really good industrial and automotive chips, so good that the Chinese insist on using them for many different things, especially their cars, and that's now become the benchmark of quality around the world. But there's a problem right now with Texas, as we call it in the trading desk. The auto and industrial markets are down in the dumps. Maybe they'll get stronger if the Fed keeps cutting interest rates. But maybe they won't. Maybe they languish because these markets are weak. Texans' earnings disappointed the Wall Street community. Now, Texas Instruments is an unusual company. It wants to be the best at what it does, and I'd argue that it is the best industrial and auto chip maker. What can it do if its end markets are weak? It's not the fault of Texas, for heaven's sake. They're just busy being great. But the analysts, they want more, much more. And they can't understand why Texas Instruments is content to remain the best house in an inconsistent neighborhood. I get the sense the Texan doesn't really care what the analysts want. This company sees them as nothing but armchair quarterbacks who don't know squat about the semiconductor business. Who's right? Look, if Texas Instruments were a private company, the answer would be easy. Management's right. Go bother someone else. They wouldn't even have to do a conference call. Privately held businesses are only accountable to themselves. But Texas Instruments is a public company, and a public company's job is to make money for its shareholders, and they're the owners. I'd argue that Texas Instruments isn't serving those shareholders well at the moment. If it wants to persist like this, management should just find a financier and take the company private. I prefer the way that Sanjay Mehrotra runs Micron, another semiconductor company. For so long as Micron's been around, it's been stuck with the rap of being a commodity semiconductor play, making non-proprietary chips that are as good as everybody else's non-proprietary chips. But that wasn't enough for Sanjay. First, he tried to make his chips more special. Tall order, the other guys do that too. But then he decided enough is enough. Micron started moving into high bandwidth memory chips for the data center. He makes the best of them. Sanjay wasn't content just to make them. He makes it so that everybody likes them, including NVIDIA. Micron's stock was at around $9 when it introduced its first high bandwidth memory chip. It's now over $100. Now, I'm absolutely convinced that if Texas Instruments wanted to, it could go beyond its cyclical nature. But it won't. It's content to remain as it is. It's just not content with the critics. It's kind of like they're an NFL team that's happy to have the best defense in the league, but no offense. Micron puts out both the offense and the defense. To me, the decision is easy. Go for Micron. After all, Texas Instruments doesn't seem to care for you. It doesn't seem to care if you don't like them. So there's no reason to own the stock unless you think that the company's really going to take itself private or put itself up for sale. And I don't think they're going to do that. Me, I want the complete team, offense and defense. So let's just say Texas Instruments management doesn't seem to respect its shareholders. And hey, today, the feeling is mutual. I like to say there's always a bull market somewhere. I promise I'll find it just for you right here at Mad Money. I'm Jim Cramer. See you Monday.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.